Have you ever wondered how some people effortlessly grow their wealth while countless others struggle to make ends meet? Well, buckle up, because I'm about to teach you the Rule of 72, which is the financial superpower the rich use to get richer. The rich are known for treating every single dollar that they have as a mini worker, instead of going out there and just spending their dollars frivolously. They put each dollar that they have to work, including the future dollars generated from the dollars they have today. But as you'll soon see, becoming a millionaire or even a multi-millionaire through the power of compound interest actually has very little to do with the amount of money that you get started with. So what exactly are these coveted investments that the rich are using to get richer and compound their wealth? Well, the truth is, most of them are actually very boring investments. That's because when it comes to earning money through compound interest, preservation of investment capital comes above all else. My suggestion to you is to get this idea of a big win out of your head. All it's going to do is lead to speculation, and eventually you will lose a substantial amount of money as a speculator. So what should you invest into instead? Well, the first and most common method for earning compound interest is by investing in the stock market, but it's very important to understand that we are not talking about stock picking. Instead, we're talking about a diversified approach to owning the broad market through something like an S&P 500 ETF or exchange-traded fund. Now, according to NerdWallet, the average return from the stock market over the long run, assuming that you are reinvesting your dividends, comes in at about 10% per year over the last century. So let's assume you have $0 to start with, but you're going to be investing $100 per week out of your paycheck or $400 per month, and we're going to first look at a 5-year time horizon of experiencing the average 10% return from the stock market. That shows that your wealth would grow to just over $29,000. If we take a look here at the difference between the blue line and the red line, that blue line is the total amount you have contributed, and the red line is the growth of that money. Obviously, at the 5-year mark, it's nothing too impressive, but just wait until you see what happens. And most people would expect that at the 10-year mark, this would be roughly double, or somewhere around $60,000. But if we click on the calculate button, we can see the magic of compound interest starting to take effect, as the portfolio has now grown to over $75,000 from $48,000 in contributions. Now let's take a look at the 25-year mark. You would have just shy of $500,000. Your total contributions are just $120,000. So in terms of gains from the stock market, you've made about $350,000, which is almost triple the amount that you actually put in. But of course, most of us have aspirations of becoming a millionaire. So if we push this out now to the 33-year mark, you would now have a portfolio value of $1.066 million. That is from $100 per week invested over 33 years, but there is something really important that we have to talk about here, and that is the tax bill associated with this type of investment strategy. If we take a look here at your contributions versus your total value, you've only invested about $160,000. That means you have about $900,000 of capital gains from Mr. Market. And if you're not using the correct type of investment account, you could be on the hook for a massive tax bill. If you have $900,000 of long-term capital gains, the top rate that you pay for federal is going to be 20%, and you might even have a state income tax depending on where you live. But even if you're just paying 20% tax, that's going to be $180,000 in taxes that you would have to pay out of your own pocket or out of your investment gains. But even worse, you would also be required to pay taxes on the dividends that you are earning along the way. That's why the type of investment account that you're using is so crucial, because you can leverage something called an IRA or individual retirement account to shelter yourself from these taxes. Now, the most common one used for this type of strategy is the Roth IRA, and that is where you are contributing your post-tax dollars, giving you no upfront tax benefit, but instead all of the benefits are at the end when you're actually withdrawing money from your IRA. If you follow the necessary steps, which the biggest one is not touching your earnings until 59 and a half, you're able to withdraw those earnings earnings 100% tax-free. And get this, even those dividends that you earned along the way are also going to be 100% tax-free. But there's an innovative company out there called I Trust Capital that's putting a new spin on this old school investment account. So let me tell you more about our video sponsor. There's a lot of crypto enthusiasts and Bitcoin maximists out there that want to hold on to their coins for the long haul, possibly even multiple decades. But that leaves them left wide open for a monster tax bill should we see Bitcoin and other crypto assets continuing to appreciate in the manner that they have. Enter I Trust Capital, the #1 crypto IRA retirement platform. Simply put, this innovative solution allows you to invest in cryptocurrencies through a retirement account, including the Roth IRA. And this gives you the same exact tax shelter effect that I just showed you in the compound interest example. And you can even roll over an existing retirement account. So if you want to diversify into alternative assets like Bitcoin or other cryptocurrencies, a rollover could be your ticket. So click the sponsored link in the description below to learn about how I Trust Capital could help you make the most out of your crypto investment. To date, they've completed over $8.7 billion in total transactions on behalf of over 200,000 investment clients. The next method for earning compound interest is likely the second most popular out there, and that is through investing in real estate, but in particular, we're talking about rental property investing. This form of real estate investing has the unique benefit of the potential for cash flows generated, assuming that the rental income collected exceeds both the mortgage and any capital expenditures, and that cash flow can be reinvested into more real estate, just like the reinvestment of dividends. However, the barriers to entry for something like real estate, and in particular rental properties, are a lot higher than investing in fractional shares of an ETF through the stock market. And that's because you need to have a significant amount of capital upfront in order to acquire your first rental property. So truthfully, you're going to need about 100 grand in order to lasso your first rental property, but do not get discouraged by this. There's alternative strategies out there like house hacking, which I even followed myself, and this allows you to leverage a low down payment loan like the FHA loan and become an owner-occupier of the rental property. Let's say you get your first rental property after a couple of years of diligent saving, or maybe you leverage the FHA loan, and after that you rent out the units and it cash flows $1,000 every single month. Well, what you could do from here is combine that cash flow with your personal rate of savings that allowed you to invest in the first rental property, and this will allow you to acquire more rental properties at a faster and faster rate. So let's say over the next 5 years after you acquire this property, you earn $60,000 from the rental cash flow, and you save up an additional $40,000 yourself from your personal rate of savings. Well, then you would have another $100,000, which could allow you to invest in yet another rental property. So you repeat the process. You put $100,000 into the next property, and this allows you to double the amount of cash flow generated to $2,000 per month. And when you combine this cash flow with your same personal rate of savings, you're going to be able to save up another $100,000 even faster. So it might take you 5 or even 10 years to get your first 2 rental properties. But after that, you might be able to get the next one in 3 years. And after that, it might take just 2 years to get your 4th rental property. And once you have a rental portfolio, the amount of cash flow that you are able to generate and then possibly reinvest is crazy. And you could find yourself in a position where you could potentially be having a new real estate acquisition every single year once you have enough cash flow. But just like with investing in the stock market, you need to have a long-term time horizon of multiple decades, and you need to have the discipline and patience in order to save up that first $100,000 or so to get started in the real estate game. But here's the thing. When you're saving up that money for your down payment on your future real estate investment, you'll actually be leveraging the third most common method for earning compound interest, which is the high yield savings account, or the CD, the certificate of deposit. Thanks to the higher interest rate environment that we are currently in, stashing your money in the bank is actually a pretty solid investment. You can earn about 5% APY or interest through various online savings accounts today, and the interest that you're earning in that account is able to earn future interest itself, just like the dividends earning dividends, allowing your savings rate to compound. Now, you're not going to be able to grow your money as fast as the stock market, for example, but the big difference is that there is no risk of downside when it comes to stashing your money in the bank or in a CD. The stock market has bull and bear markets, and in the bad times, a 20 to even 50% drop is possible. While over the long run, the stock market has always trended upwards and generated positive returns when you invest broadly in something like the S&P 500, if you have bad timing with the market, you could be stuck in the red for years until your investment turns over into the green if you experience a bear market. So that's why with something like a down payment for a piece of real estate, you don't want to be investing that money into a financial asset like the stock market. But that brings up an important question. How do you compare a 5% interest rate from a savings account to a 10% rate of return from the stock market? Well, my friends, enter the all-important Rule of 72. The Rule of 72 is a quick and simple method that is used to estimate the time it takes for an investment to double in value. The rule states that you can approximate the number of years it will take for an investment to double in value by simply dividing 72 by the annual rate of return that's expected from that investment. So let's take the 10% average return from the stock market. If you take 72 and divide it by 10, this gives you 7.2. That means on average, it's going to take 7.2 years to double your money by investing broadly into the stock market through the S&P 500. With the bank account example of 5% interest, if we take 72 divided by 5, we end up with 14.4 years being the amount of time it would take your money to double from that rate of return. So it would take twice as long to double your money with a bank account based on the current interest rate environment compared to the stock market based on that average 10% return. But again, keep in mind that both are going to be a necessary component of a well-rounded portfolio. And the biggest secret out there for becoming wealthy, leveraging compound interest, is allowing yourself to have as many of these doubling cycles as possible by giving yourself a long time horizon. So we already said it takes about 7.2 years to double your money based on the average return from the stock market. So if you have 36 years to invest, well, that means you're going to have roughly 5 doubling cycles. And that could mean $50,000 that you double to 100 grand, 100 into 200, 200 to 400,000, 400 to 800,000, and finally 800,000 doubling to 1.6 million. And once again, consider the type of account that you are using, because something like an IRA can make all of the difference when it comes to avoiding a monster tax bill. Thanks so much for tuning in, guys. Don't forget to click the sponsored link down below to check out I Trust Capital, the #1 crypto IRA retirement platform. If you enjoyed this video, please drop a like. Don't forget to subscribe and hit the bell for all future notifications. You can click below to watch my video on Fidelity Index Funds for beginners, and I hope to see you there.